The world's biggest TikTok creator just vanished from the stock market, and his $975 million deal has gone up in smoke. Khaby Lame, the bloke who built a fortune by silently mocking overcomplicated life hacks, has found himself in a financial mess that's anything but simple. Here's what happened. Lame struck a deal to take his brand public through what's called a SPAC, a special purpose acquisition company. Think of it as a backdoor way to list on the stock exchange without all the usual paperwork and scrutiny. The deal was meant to value his personal brand at nearly $1 billion. Then brokerages started blocking trades in the stock. Now nobody can buy or sell it, and Lame has gone radio silent. This isn't just celebrity gossip. It's a perfect example of how the creator economy bubble might be deflating and why Australians need to be bloody careful about chasing the latest investment trend. Let me explain what SPACs actually are, because they've been popping up everywhere lately. A SPAC is basically a shell company that raises money from investors with the promise of finding something interesting to buy later. They call them blank check companies for good reason. You're literally giving your money to someone who hasn't told you what they're buying yet. The SPAC craze peaked in 2021 when everyone was throwing money at anything that sounded remotely innovative. Electric vehicle companies, space tourism, crypto platforms. If it had a fancy presentation and a celebrity endorsement, it could raise hundreds of millions through a SPAC. But here's the thing about trends. They end. And when they do, they usually end badly. The ASX has seen its fair share of these blank check deals, though we call them different things here. We've had our own pump and dump schemes, our own companies that promised the world and delivered nothing. Remember when every second company on the All Ordinaries was suddenly a blockchain technology business? How'd that work out? The Khaby Lame situation highlights something crucial about celebrity investments and the creator economy. Just because someone can make millions from social media doesn't mean their business is worth $1 billion. There's a massive difference between personal brand value and actual business fundamentals. Let's talk numbers for a second. Lame has over 160 million followers on TikTok. That's impressive. But followers don't equal dollars, especially sustainable dollars. The creator economy is built on attention, and attention is the most fickle commodity on earth. One algorithm change, one platform policy shift, one cultural moment, and your entire empire can crumble overnight. This matters for Australian investors because we're seeing the same pattern here. ASX-listed companies are desperately trying to attach themselves to social media trends, influencer marketing, and creator economy plays. Some are legitimate businesses, others are just riding the wave. So how do you tell the difference? Start with revenue. Real revenue, not projected revenue or potential revenue. If a company's entire business model depends on a social media platform they don't control, that's a red flag the size of Uluru. Look at the recent performance of tech stocks on the ASX. Many companies that were trading at ridiculous multiples in 2021 have come back to earth. The market has remembered that businesses need to actually make money, not just generate buzz. The broader economic context here makes this even more relevant. With inflation still running hot globally and central banks walking a tightrope between cutting rates and fighting price pressures, speculative investments are getting hammered. The era of free money is over, and investors are demanding actual returns, not just growth stories. For Australians, this creates both challenges and opportunities. The challenge is that our superannuation funds and managed investments often get caught up in these global trends. When international tech stocks and SPACs crash, it flows through to Australian portfolios. Your super balance doesn't care that you never heard of Khaby Lame. If your fund was invested in creator economy plays, you're feeling the pain. The opportunity is that sensible Australian businesses trading at reasonable prices start to look attractive again. Companies with actual earnings, dividends, and business models you can understand. Boring stuff like banks, miners, and utilities that keep the lights on and pay regular income. This doesn't mean avoiding all growth investments, it means being smarter about them. When someone pitches you on the next big thing, Whether it's a SPAC, a crypto project, or an ASX-listed company that suddenly pivoted to artificial intelligence, ask the hard questions. What's their revenue? Where does it come from? How sustainable is it? What happens if their main platform or customer disappears tomorrow? If you can't get straight answers to these questions, walk away. The creator economy isn't going anywhere, but the valuation bubble around it is deflating fast. Smart money is moving from growth at any price to growth at a reasonable price. That's particularly true in Australia, where we've always been a bit more skeptical of pie-in-the-sky valuations. Here's what this means for your money right now. If you've got investments in tech-heavy ETFs or managed funds that chase the latest trends, take a closer look. You might be more exposed to creator economy risks than you realize. Many global tech funds loaded up on these types of plays when they were hot. Consider rebalancing toward more defensive positions. That doesn't mean stuffing your mattress with cash, but it might mean increasing your allocation to Australian dividend-paying stocks, real estate investment trusts, or even just keeping more in high-interest savings accounts while the dust settles. The RBA's current monetary policy settings actually support this approach. With the cash rate sitting where it is, you can get decent returns from term deposits and savings accounts, something that wasn't possible during the zero-rate environment that fueled the SPAC bubble in the first place. For younger Australians building wealth, this is actually good news. Market corrections create buying opportunities, but only if you're not caught up in the wreckage of the previous bubble. The key is patience and discipline. The Khaby Lame situation also highlights the importance of diversification, not just across asset classes, but across risks you might not have considered. Platform risk is real. Regulatory risk is real. Celebrity risk. The chance that your investment depends on one person staying popular and scandal-free is very real. Think about this when you're building your investment portfolio. How much of your wealth depends on things outside your control? Social media algorithms, celebrity behavior, regulatory changes in other countries. The more concentrated these risks, the more vulnerable you are to exactly what's happening with this TikTok deal. The silence from Khaby Lame's team tells us everything we need to know about how this is likely to end. When deals fall apart and brokers start blocking trades, the retail investors always get hurt the worst. The insiders find ways out. The promotional partners distance themselves. The regular punters get left holding worthless paper. This pattern repeats itself every few years in different forms. Dot-com stocks, cryptocurrency projects, property development schemes, and now creator economy SPACs. The names change, but the story stays the same. Easy money turns out to be not so easy after all. The real lesson here isn't to avoid all risk or never invest in growing industries. It's to maintain perspective and remember that if something sounds too good to be true, it probably is. A social media creator's brand being worth nearly $1 billion definitely sounded too good to be true. As this creator economy correction continues to unfold, keep your wits about you. There will be opportunities in the wreckage, but there will also be plenty of people trying to sell you on the next sure thing. The difference between building wealth and losing money often comes down to knowing when to say no. The TikTok king might have lost his voice, but the market is speaking loud and clear. Fantasy valuations are over. Real businesses with real profits are back in fashion. And frankly, it's about bloody time. This is general information only and not financial advice. Please speak to a licensed financial advisor before making any investment decisions.